Brad, thanks so much for joining us here this morning. So the news about the restrictions on the AI chips is not enough to deter you from looking at the semi space in the long run? Is it just sort of a frustrating development, or is it bigger than that?
Yeah, it certainly is a frustrating development as owners of the semiconductor sector, but we've got to look across the whole chip sector broadly and really understand that it is the engine that underpins all of the digital transition of the global economy. It's running the cloud, it's running the software, it's running the apps, it's running the devices, the robotics, the automation. It is increasingly the sector of semiconductors at large is becoming more important. We invest across that entire spectrum of assets, not just in the chip sector, but across technology and other sectors as well, and we still see plenty of opportunities. We're clearly going through some issues with restrictions in China. That's not going to stop. It's been going. It's going to keep happening as tensions rise between the two countries. We're going through an inventory correction. We know what's going on with the macro globally, but a lot of negativity is priced in. The stocks have pulled back a lot. It's always hard to know exactly what's priced in, but as long-term investors, we see a lot of opportunities.
You know, I understand your point. Certainly technology is sort of leading the way forward in many cases, but it's also leading the market down. Again, here today, much lower for the NASDAQ than some of the other stocks. Why are you so positive on these names, and what should your horizon be if we're still looking at economic growth contracting a bit here and tech potentially being hurt worse than other names?
Yeah, so the reason we're positive and technology remains, the tech sector remains a little over half of our portfolio today. One, the market has pulled back a lot, so it reflects a lot of the potential negativity over the coming 12 months. But two, technology is the deflationary force of the economy. That's been the case, going all the way back to when the wheel was invented. I mean, when we come up with these technologies, we're more productive, we do things quicker, we do it with fewer people, and that is sort of an accelerating trend in technology as things shift to the cloud, as things go digital, as AI becomes more relevant and is able to automate a lot more functions that are out in the economy. If you're sitting there running a company today, your best option really is to leverage technology to drive deflation in your business to offset the inflation that's out there. And the inflation, maybe it goes away, maybe it doesn't, but it's causing companies to say, hey, we've got to invest in technology. And we've seen that in the results of tech companies. Although some of them have been a little bit weaker, they're still holding up on a fundamental basis in terms of the revenue growth, and the outlooks there are stronger than some other areas in the market.
All right, well, what does that mean then? I mean, these long-term trends are great. They make a lot of sense, Brad, but you're in business to make money for your clients, I would assume, which means you got to buy them at the right time and potentially sell them. NASDAQ's down over 25% year to date. What names, where, are you down for the year at this point and buying more right now because you think it's a great opportunity, or are you a bit more cautious?
Yeah, so you've got to think about it in terms of the broader context of a portfolio. You've got to have your position sized right. You've got to leave room, of course, to buy more if things keep going down or things are worse than you think. But there are areas we do think, like Workday had great results last week. They are helping companies automate processes, drive productivity across their software that the companies run. There's just a lot of opportunities out there, and you've got to be in the game because you can't call the bottom. The market can make you feel sort of a lot dumber than you are when it's down like this, but you've got to focus on what are the numbers going to be a year from now, 2 years from now, and is this the right time? And, we feel like, particularly with this most recent pullback, that there are a lot of opportunities out there.
Shepard Smith here. Thanks for watching CNBC on YouTube.